In today's video, we will be going over 8 different ways that rental properties actually make you wealth. On the surface level, people only tend to associate rental property investing with how much money you have left over each month after collecting the rent and paying all of your expenses. And at the end of the month, if you have money left over, it's a good rental property, and vice versa. If you are left with no money at the end of the month, then it's a bad rental property. Well, I'm here to tell you that that thought could not be any further from the truth. I will be discussing 8 different ways that rental properties create wealth for you. All 8 ways I'll be talking about will be timestamped down in the description below if you feel like skipping around. And don't forget to like and subscribe to my channel for more real estate investing content like this. So let's get right into it. Now, the first way that you create wealth from rental properties is with cash flow. Cash flow is the difference between the income you receive from the property and the expenses every single month. For example, let's say you have a property that's bringing in $2,000 every single month, but the expenses on those property, including your principal, interest, taxes, insurance, utilities that you have to pay for, all that comes in at $1,600. That means that you have a total of $400 every single month of cash flow. And if you break that down yearly, that's $4,800 of cash flow that you'll receive for that year. But just remember, you cannot avoid maintenance and repairs, so make sure to take a chunk of that and put it to the side for reserves for when things like that happen to your property. Moving on to number 2, which is appreciation. Appreciation is the increase of your property's value over time due to a number of factors. The factors can include population growth, demand in housing, new development in your area, and inflation. Now, the 2 types of appreciation includes organic appreciation and forced appreciation. Organic appreciation is very reliant on demand and inflation, while forced appreciation is more reliant on forcing appreciation through renovation, increasing the net operating income, and buying at a discount. Take my 4-unit apartment complex, for instance. We purchased this property in 2020 for $430,000. Today in 2023, it's worth about $550,000 to $575,000. And that was from a mixture of both organic and forced appreciation. And this is why I am a huge proponent of buy real estate and wait. Do not wait to buy real estate. Which leads us to number 3, which is buying equity. And what I mean by buying equity is when you purchase real estate at a discount. Once again, take our 4-unit for instance. When we purchased this for $430,000, it appraised for $450,000. That means that just by signing that we were going to purchase this property, we gained $20,000 of equity. And that was from the jump, not having to do anything to the property yet. The best way of buying equity and purchasing property at a discount is to locate off-market opportunities and purchase direct to seller. Now, that is a lot harder said than done, but if you're able to locate off-market sellers, you can negotiate one-on-one and end up getting great deals rather than going on the MLS or any property that's on the market and having to compete with multiple offers. Now, this 4th way is such a valuable tool to use, and I personally have utilized this strategy to build wealth through real estate. Number 4 is self-leveraging, aka leveraging your equity. When you own real estate, you accumulate equity. And this is due from paying down your mortgage and appreciation through real estate to where the value of your property increases. And once your equity increases, you can utilize some strategies in order to purchase more real estate and build more wealth. Now, there are 3 main ways that you can leverage your equity. The first is a HELOC, a home equity line of credit. Now, this is a revolving line of credit with a variable interest rate depending on the prime rate of the market. Typically, you have a draw period and you have a repayment period. When you're in the draw period, you can draw from your home equity line of credit, pay it back, and use it just similar to a credit card. But with a home equity line of credit, you can make interest-only payments while you're in your draw period phase. But once you get into the repayment period, that's when you cannot use any more of your home equity line of credit, and you'll have to pay principal and interest until you pay off the remaining balance that you use. I personally have used a home equity line of credit to purchase a rental property that cash flows, pays back that HELOC payment for me, and is building me wealth. The second way is a home equity loan. This is a fixed rate option to where you leverage your equity, you get a loan from your equity, and you can use that to invest in assets. This one is very similar to a car loan to where once you get approved for it, you start paying on it right away, and it is a fixed rate. And lastly, you can do a cash out refinance. This is where you would go get a brand new loan for a higher amount that would pretty much pay off your existing mortgage and pretty much pay you the difference of the two. So let's say you owe $100,000 on your property, you do a cash out refinance, it appraises enough to where you can take out a $150,000 loan. That means that you will receive $50,000 in cash and start paying on the higher mortgage. The benefits are that you receive cash in hand to where you can do anything you want with. The negative is that you will most likely have a higher mortgage payment that lessens your cash flow every month on a property. All three of these options allow you to leverage the equity inside of your home in form of a loan or cash in order to reinvest into more real estate. Owning real estate comes with a lot of tax advantages to where it can lower your taxable income and save you money. From my research, here are some tax advantages that you get from real estate investing. You can deduct the interest paid on your mortgage from your taxable rental income, reducing your taxable profits. Property taxes paid on your rental property can be deducted from your taxable income. The value of the building, not including the land, can be depreciated over time, allowing you to deduct a portion of its value each year as a non-cash expense. Costs incurred for repairs and maintenance on the rental property can be deducted from your rental income. If you need to travel to manage your rental property, you may be able to deduct certain travel expenses. If you have a dedicated space in your home for managing your rental activities, you may be able to qualify for a home office deduction. The cost of utilities and insurance related to your rental property can be deducted from your rental income. Fees paid for legal and professional service related to your property can also be deducted. Rental property losses can often be deducted against other passive income, reducing your overall tax liability. And if you sell a rental property that has been your primary residence for at least 2 out of the 5 years, you may qualify for a capital gains tax exclusion. Now, like I said, these are just ones that I personally have researched and found. I'm sure there are many more, but if you're interested in learning any more about any tax advantages of owning real estate, I highly suggest that you go and reach out to your CPA or tax professional for that. Moving on to number 6, which is loan paydown. Loan paydown is probably self-explanatory, but if you do this correctly, your tenants will be paying down your loan for you. Even if you are breaking even from your rental property, which means you're not bringing in or losing any income each month, you are still earning value from this property because your tenants are paying down your loan. Now, with a mortgage payment, there is principal and there is interest. But let's say you have a mortgage payment of $1,000 and $500 of that is going straight into your principal. Each year, you will lower your total mortgage on that property by $6,000. And if you are making money or breaking even on that property, the tenants are doing it for you. Don't forget that that $6,000 increases your equity in that property by $6,000 every single year. Moving on to number 7, which is real estate is a hedge against inflation. Now, over time, you may have noticed that groceries, gadgets, anything that we purchase as consumers increases in value. And when that happens, it's due to inflation. But some people don't understand that inflation actually decreases the value of our money. And it can buy less of what we used to be able to buy. For example, the average cost of milk in 2010 was about $3.30, while as in 2022, it was $4.34. So with that same $3.34 in 2010, we cannot buy milk. We cannot buy milk today. And if you are someone who stacks all your money in a savings account or underneath your mattress, then it may not be worth the same in 5 to 10 years. But here's where real estate hedges the inflation. Real estate typically increases in value over time. So when everything rises in value, just like milk, your real estate increases as well due to inflation. And with real estate, you can own something that keeps pace with or even beats inflation. Now, the last way I'll be talking about that can build you wealth through owning rental properties is your 1031 exchange and tax deferral. A 1031 exchange is a tax break. You can sell a property held for business or investment purposes and swap it out for a new one that you purchased for the same purpose, allowing you to defer capital gains tax on the sale. Now, I'm not going to go into every little detail with a 1031 exchange. The basic concept is that if you own a rental property for more than 5 years and have not lived in it, then you have to pay capital gains when you go to sell it. But let's say you have a property worth about $200,000 that has no mortgage on it and you owned it as a rental property. If you go to sell that property, you'll have to pay a large capital gains tax. Or you can do a 1031 exchange, which takes all of the proceeds untaxed, and you are now able to take that money and go invest that whole $200,000 into a new asset at a higher price and defer your tax. Essentially, it allows you to trade in the rental property you own for a much more expensive rental property that hopefully brings in more cash flow, more appreciation, and more real estate benefits for you. And this is really how real estate investors build wealth. Well, those are the 8 ways that you actually build wealth through real estate investing. And I hope you guys enjoyed. If you like this, please give this a thumbs up and subscribe to my channel for more real estate investing content. And I will see you guys in the next one. Happy investing.